Most people think financial crises start with panic. They don't. Panic is never the beginning. Panic is the consequence. Every major financial crisis starts quietly, long before headlines, long before fear, long before people even agree that something is wrong. And the reason most investors lose money is not because they don't see the crash coming. It's because they don't understand which phase they're in when it arrives. Right now, millions of people know a crisis is coming. They feel it, they talk about it, they sense it in prices, in debt, in politics, in instability. But knowing a crisis is coming is not the same thing as understanding how it unfolds. Crises don't arrive as a single event. They unfold in phases, predictable phases, repeating phases. And if you misread even one of them, you end up doing the right thing at the wrong time, which is often worse than doing nothing at all. Today, I want to walk you through the first 3 phases of every major financial crisis, using real examples from 1929, the dot-com collapse, and 2008. Not theory, not hindsight bias, but patterns that repeat because human behavior repeats. And once you see these phases clearly, you'll never look at markets, news, or buy the dip advice the same way again. Every crisis begins with anticipation, not fear. Anticipation. This is the phase nobody talks about because nothing dramatic is happening yet. Markets are often near all-time highs. The economy looks fine on the surface. Unemployment is low. Asset prices are strong. Confidence is high. But underneath that surface, cracks are forming. In the late 1920s, before the Great Depression, credit was expanding rapidly. Leverage was increasing. Stock speculation was rampant. People were buying shares on margin with almost no understanding of risk. Newspapers talked about a new era of prosperity. Productivity gains were real, but prices ran far ahead of reality. In the late 1990s, before the dot-com collapse, the story repeated almost word for word. The internet was real. Technology was transformational, but valuations disconnected completely from profits. Companies with no revenue were worth billions. Risk was ignored because the future felt inevitable. Before 2008, it was housing. Real estate prices never fall, people said. Credit was cheap. Lending standards collapsed. Banks packaged risk into instruments almost nobody understood. On the surface, everything looked stable. Underneath, the system was fragile. This phase always feels the same psychologically. People acknowledge problems but dismiss them. Yes, there are excesses, but this time is different. Yes, valuations are high, but rates are low. Yes, debt is rising, but growth will handle it. This is the phase where the smartest sounding arguments are often the most dangerous because they justify staying exposed when risk is quietly rising. We are in this phase, again, record public debt, tightening financial conditions, asset bubbles driven by narratives rather than cash flows, structural shifts in labor and technology, geopolitical instability, and yet markets still function. Life still feels normal. That's why this phase is so deceptive. Nothing breaks yet, but the system becomes brittle. Then comes the second phase, the first visible crack. This is the moment people later point to and say, that's when it started. But at the time, almost nobody recognizes it as the beginning. In 1929, it was the initial sharp declines in October. The market fell hard, bounced, fell again. Many believed it was just a correction. Buying opportunities were everywhere. Newspapers reassured the public. In 2000, it was when the Nasdaq peaked and started falling. The first wave down wiped out some excess, but many believed the strongest companies would be fine. This isn't a crash, people said. It's a rotation. In 2008, it was Bear Stearns, then Lehman Brothers. Even after Lehman collapsed, many believed the worst was over. Governments would step in, central banks would stabilize things. This was just a shock, not a systemic failure. This phase is defined by confusion. Markets fall, but not enough to scare everyone. Volatility increases. News becomes contradictory. Some assets recover temporarily, others don't. Optimists and pessimists argue aggressively. This is where the phrase, buy the dip, becomes most dangerous. Because sometimes dips are opportunities, but sometimes dips are warnings. The problem is that in phase 2, you cannot tell which one it is by looking at prices alone. The system is still functioning, but trust has been damaged. And then comes phase 3. This is where everything changes. Panic and forced selling. This is the phase people imagine when they think of a crisis, but by the time it arrives, it's already too late to prepare. Phase 3 is not about opinions. It's about mechanics. Margin calls hit. Funds face redemptions. Leverage unwinds. Institutions are forced to sell assets not because they want to, but because they have to. In this phase, correlations go to 1. Everything sells off together. In 1929, this phase unfolded over years. Banks failed. Depositors lost money. Businesses collapsed. Deflation set in. Asset prices didn't just fall, they kept falling. In 2008, this phase was violent and concentrated. October and November were dominated by forced liquidation. Hedge funds sold stocks, bonds, commodities, anything liquid. Credit markets froze. Trust evaporated. In March 2020, this phase was compressed into weeks. Stocks crashed. Bonds sold off. Even traditionally safe assets were dumped. Gold fell initially. Bitcoin collapsed. It wasn't because these assets failed fundamentally. It was because liquidity disappeared. This is the most important lesson of Phase 3. Markets stop pricing value. They start pricing survival. The goal of every actor becomes the same: raise cash, reduce risk, stay alive. In this phase, good assets get sold alongside bad ones. Profitable companies trade like bankrupt ones. Long-term investments are liquidated for short-term survival. This is why people who thought they were diversified suddenly realize they're not. This is also why people misunderstand safe havens. A safe haven does not necessarily go up during panic. A safe haven is something that survives panic with less damage and recovers faster once forced selling ends. In Phase 3, even gold can fall. Even bonds can be stressed. Even cash can feel scarce. What matters is not what performs best in a spreadsheet, but what allows you to avoid being forced into bad decisions. This is the phase where most wealth is destroyed. Not because prices are low, but because people are forced to sell at the worst possible moment. And this phase always feels unfair. People say, I did everything right. I bought quality. I diversified. I thought long-term. But long-term thinking only works if you survive the short-term mechanics. Phase 3 does not reward patience. It rewards preparation. If you enter this phase over-leveraged, illiquid, or emotionally exposed, the market will decide for you. This is why understanding these phases matters more than predicting the exact trigger. Because by the time panic is obvious, positioning is no longer a choice. It's a consequence. And here's the critical transition. Phase 3 is not the end. It's the cleansing. It's where excess is purged, leverage is destroyed, and weak structures collapse. What comes after is where opportunity begins, but only for those who made it through this phase intact. That's what we'll explore next. Because once panic exhausts itself, the system doesn't heal immediately. It enters a new phase entirely, one that looks like stability but hides a different kind of danger. And if you think surviving panic is hard, navigating what comes after is even harder. Before moving forward, if this video made you stop and think, then the conversation doesn't end here. Leave a comment below and tell me what topic you want us to go deeper into next. This channel exists to break down what most people are never told, and your questions shape what comes next. If you want to understand these shifts before they become obvious to everyone else, make sure you subscribe, like this video, and turn on notifications. Because what's coming won't be explained on the evening news, but it will be explained here. Once panic and forced selling reach their peak, something subtle but extremely important happens. The market doesn't suddenly recover. It goes quiet. This is Phase 4, the liquidity scramble and survival mode. This is the phase almost nobody talks about because it's not dramatic. There are no massive red candles anymore. No historic headlines every day. Instead, there's exhaustion. The selling slows down, not because confidence has returned, but because most of the forced sellers are already gone. Leverage has been wiped out. Weak hands are out. What remains is a system that is deeply wounded but still standing. In this phase, the behavior of participants changes completely. Companies stop thinking about growth. They think about cash. They draw credit lines. They cancel investments. They fire people. They hoard liquidity, even if it hurts long-term prospects. Banks become defensive. Lending standards tighten aggressively. Credit becomes scarce and expensive. Risk departments take over decision-making. The question is no longer, how much can we lend, but how much can we lose? Investors change as well. Nobody cares about upside. Everyone cares about not blowing up. Portfolios are simplified. Exposure is reduced. Complexity is punished. In the early 1930s, this phase lasted years. Businesses collapsed slowly. Deflation set in. People saved cash, not because it earned anything, but because everything else felt dangerous. In 2008, this phase showed up as a credit freeze. Even strong companies struggled to access financing. Interbank trust evaporated. The system functioned, but barely. In 2020, this phase was short because policy intervention was immediate and massive. But even then, for a brief moment, survival mode dominated everything. This phase is where opportunity quietly begins to form, but only for those who have liquidity and patience, not courage, patience, because in Phase 4, prices are low, but visibility is worse. Nobody knows how deep the damage really is. Earnings are unreliable. Data is backward-looking. Every forecast feels wrong. This is where most people make their second big mistake. They confuse stabilization with recovery. They see markets stop falling and assume the crisis is over. It isn't. That brings us to Phase 5, policy intervention and artificial stability. This is the phase where governments and central banks step in forcefully, not subtly, forcefully. In the 1930s, it was the New Deal, massive public works, banking reforms, new rules for an old system. After 2008, it was quantitative easing, zero interest rates, bailouts, liquidity injections on a scale never seen before. In 2020, it was stimulus checks, emergency lending facilities, corporate bond purchases, and fiscal spending at wartime levels. This phase always feels like relief. Markets rally, volatility drops, headlines improve, politicians declare success, central bankers assure the public that stability has been restored. And technically, they're not lying. Stability has been restored. But it is artificial stability. The system is not healed. It is supported. This distinction is critical. Artificial stability changes behavior again. Risk slowly creeps back in. Speculation returns earlier than fundamentals justify. New bubbles can form on top of unresolved structural damage. This is why many people get trapped here. They think the crisis is over because prices go up. They re-risk too early. They ignore balance sheet damage. They forget that policy cannot erase debt, only redistribute it. After 2008, this phase lasted years. Markets recovered long before the real economy did. Inequality widened, debt increased. Structural problems were postponed, not solved. After 2020, the same thing happened faster. Markets surged while supply chains broke, inflation built, and debt exploded, which leads us to phase 6, aftershocks and secondary failures. This phase is cruel because it arrives after people think the danger has passed. The initial collapse is over, panic is gone, policy is in place, and then something breaks again. In the 1930s, it was the 1937 recession, a sharp relapse after apparent recovery. After 2008, it was the European sovereign debt crisis. Countries didn't fail immediately. They failed later under the weight of accumulated debt. After 2020, the aftershock came as inflation, rate hikes, banking stress, and asset repricing. Not during the lockdowns, but years later. This phase punishes complacency. Businesses that survived the first shock fail because refinancing becomes impossible. Investors who chased the rebound realize the system is still fragile. Governments tighten policy after overstimulating, creating new stress. This is where narratives collapse again. People ask, I thought this was fixed. Why are we back here? The answer is always the same, because crises don't end when markets stabilize. They end when imbalances are resolved, and that takes time. Finally, we reach phase 7, repricing and real opportunity. This is the phase that almost nobody experiences fully, because it requires something rare: capital, patience, and emotional control. By this point, assets are repriced realistically. Weak players are gone. Business models that survive have proven resilience. Risk premiums are high again. In the late 1930s and 1940s, this phase laid the foundation for decades of growth. After 2009, it created generational opportunities in equities, real estate, and businesses, but only for those who had survived the earlier phases intact. This is where wealth is actually built, not during panic, not during stimulus-driven rallies, but after the system has been cleansed. And now we arrive at the final reframe. Crises do not repeat exactly. The triggers change, the technologies change, the politics change, but the phases repeat with frightening consistency. Anticipation, trigger, panic, liquidity scramble, policy intervention, aftershocks, repricing. The people who lose the most money are not the ones who done TC the crisis coming. They are the ones who misidentify the phase they're in. They take risk when they should preserve. They preserve when they should deploy. They panic when patience is required. The people who emerge stronger are not smarter. They are more disciplined. They understand sequence. And that is the most important takeaway of this entire video. You don't need to predict the exact trigger. You don't need to time the bottom. You don't need perfect foresight. You need to know where you are in the cycle and act accordingly. Right now, the most dangerous thing you can do is confuse anticipation with opportunity. Crises reward those who survive the early phases with control, liquidity, and clarity. Everything else comes later. And if you understand that now, before the next phase fully reveals itself, you're already playing a different game than most people around you. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.